Hi, morning, everyone. I'm so sorry for the technical glitch. We're good to go. So basically, this presentation is going to be summarizing, domestic as well as global macros and how they're playing a part in, influencing the central bank and their policy, thought process. To just run you through the presentation. So basically, the key themes that we're going to be covering here essentially will be, whether we're seeing a world which is probably getting into a disinflationary mode. If at all, what are the implications for the same? Will that also be a sign of a recession that probably is impending, and how synchronized is going to be this time around in the world? What it implies for the Fed, for the RBI, what it implies for India's growth story, what it implies for India's asset classes, and how it could really play out from our domestic positioning of assets in general. Well, to start off, this time around, the last year that we saw was a year of major mispricing. The previous year was a major mispricing on inflation. The year that passed was a major mispricing on how fast and how fast and how deep the Fed rate hike can actually go. As we stand today, or as per yesterday's FOMC policy, what we understand is that somewhere the Fed has sort of decided to call it a pause at 5.25, which is a tad lower than what most people were talking about in early March before the SVB crisis happened in the US, which essentially implied that even though we are looking at a de facto less tightening by the US, which obviously has given breather to emerging central banks, and that to central banks like that of RBI. In some sense or the other, it is also probably a tightening which is coming from a different angle, which is basically a much tighter banking sector regime, where you will see the lending standards probably tightening much more than they would have had there been no crisis as such. So I think this chart, which I'm showing essentially here, is that there's never been a case in time when you've seen Fed tightening rates to such an extent. In fact, this is the fastest in the history of the US rate hikes that you've seen, wherein in a matter of only 14 months or so, we have seen rate hikes which are essentially as high as around 5% plus. This is, I think, the second, the last fastest that we saw previously was that of the GFC crisis, which had led to a 475 rate hike, but that happened over a period of 2 years. And I think 15 months following that is what we saw the financial crisis happen. So that was the last, big recall that one has of the US Fed. But clearly what you're seeing here is that, every crisis in the past, which has, happened because of the Fed hikes, has essentially somewhere or the other, the Fed being the lead in terms of rate hikes. Now, this time, lead in terms of a recession. This time around as well, when you're looking at the, current dynamics, what you really see is that, the real estate pricing, for that matter, is the next leg which could have a crisis impending, because if you look at the current share of commercial real estate specifically, almost 70% of the commercial real estate loans are actually owned by small and marginal small and medium-sized banks in the US, which are still the problem pain point as we stand today. Even before the crisis that started brewing in the US, what we really saw is that the credit conditions were already tightening to a large extent. And this chart is essentially showing that even before the crisis, we were actually seeing the credit conditions tighten as high as what you've seen in the pre-crisis period in the past. And historically, they have a very good correlation with the the actual loan growth that you see with a lag of 1 year. So there's a good chance that, in a matter of a year or so, you probably will be seeing the credit condition tighten to the extent that it'll start looking at impinging on the loan growth to the extent of almost negative loan growth, which is, again, somewhere a precursor to a recession in the West. At this point in time, if you look at, how the US growth is panning out, there's still not very secular signs in terms of where this growth is actually headed. So if you see the last cycles in the US, or wherever, as I said, there's always been a pain in the US economy whenever the US Fed has hiked to such an extent. All these cycles where you see, actually, you realize that there's been always a bit of a problem with regard to how the growth story has panned out. And I think on an average, between 6 months to as good as 12 or 19 months, you generally see a recession happening in the US after the last hike that gets done. As we stand today, most people who, including the Fed governor, who believes that they are still looking at a no landing scenario as far as his own analysis is concerned. If I go back and listen into him in terms of yesterday's speech, he still is going by the fact that, even though we've seen job losses in the US in the last 6 months or so, the unemployment rate has remained stable, quite solid for that matter, close to around, cyclical lows in a growth cycle, which is 3.5% or so. I think he sort of is alluding to the fact that, generally you're looking at a much stronger backdrop in the US economy, especially because the balance sheets historically have never been this strong in the US. When you look at the past cycles, all the past crisis cycles have actually seen, recession being led by a very high leveraging cycle, which is not the case as we stand today in the US. As I said, there's a mixed recession signals at this point in time. There are various, checklists that you see generally in this. Yeah, so at this point in time, as we stand today, there have been still very mixed recession signals in the West. Historically, what you've seen is that the yield curve, which is, I think, seen by everybody as a very reliable indicator for recession in the past, generally tends to show that, from the point of inversion, which is basically 10-year, 2-year gap, on an average around 17 months is what you see the next recession actually hitting the economy. So if I see in this particular cycle, we had seen the inversion happening in, I think summer of last year, which essentially means that in a good likelihood, we should be seeing a recession hitting the US economy by the end of the year, which obviously also implies that the market is trying to be ahead of themselves. This chart is obviously 2 days old. Overnight, there's been a big change in the way the market pricing is happening. There's been a front loading of the market pricing again, which now is implying that you will see as high as 75 bips rate cut by December of this year in the US, followed by, another 35, another 100 bips cut in the US by the end of 2024. So basically, by the summer of next year, as per the market pricing, you're probably going to be seeing a 3.5 or below that in the US Fed, which essentially implies that if that kind of a rate cut is happening, it would ideally start by as early as June, July of this year. Now, sitting today, if you listen to the Fed governor, who's sort of become non-committal in terms of where they're going next, it looks to be a little bit of a difficult task for me to absorb the fact that you're looking at such high rate hikes in a matter of just 2 months or so. It essentially implies that somewhere you're looking at a period wherein, probably you're going to be seeing a very high chance of a major policy accident in the next 2 months or so, which essentially implies that you're going to be seeing a very high recessionary case in point. And that doesn't seem to be a situation for me sitting today. So my sense is that market is sort of overpricing in terms of a rate cut. We're expecting Fed to change their stance in terms of, policies action by early next year and not by end of this year, at least until, of course, the economic recovery economic slowdown remains somewhat manageable. I don't think that the banking crisis is going out of hand at this point in time. And of course, there are moral hazards in terms of how they are managing it. But expecting, a rate hike as high as a 175, 200 bips in a matter of 1.5 years is, I think, too much of a stretch for the markets. And that is what is spilling across, rates market in the world. India has also benefited from that. I'll come to that bit. But clearly, somewhere something is missing in this picture because you can't have it both ways, because if you really are looking at a major crisis, which is implying that you're looking at rate cuts starting as early as June, July of this year, the equity market is somewhere mispricing it, right? And then there's not been a great crash in equities, barring just the regional banking crisis. So something is a mismatch in terms of how one should understand the bond market assessment of the Fed fund pricing. Because if that is sort of going to be the case, then you also will be looking at a situation there where across the world, you should start looking at cuts being priced in. As we understand, just day before, the Reserve Bank of Australia, which had paused, had again hiked. We also saw Hong Kong hiking today. We also saw Malaysia hiking today. Both of them had actually paused their rate hike. Interestingly, when you go back and read RBI's last minutes, which was the last policy, which was a big surprise, if you just read the minutes and not seen the policy, I don't think anybody would have thought it's a hike. It's a cut, or sorry, it's a pause. It was very clearly, a divided MPC. It was very clearly an MPC of 4-2 at best. It wasn't an MPC which actually voted from their heart, but probably more out of their supposed compulsion or lack of understanding of what is happening in the economy. And unfortunately, there was not much of a discussion with regard to why essentially they changed their policy stance to a pause from a hiking mode. And that is why I think it's very, if you just read the RBI minutes, you'll actually realize that RBI themselves are not very convinced as to where the next point of action is going to be. And somewhere, if the Fed fund pricing is correct, and if you're actually looking at a big, disaster in the US, because this is what the market pricing is in terms of rate cuts, I think the implication across the world will be very different from what it is at this point in time. So in the past, Fed fund futures has been wrong. Last year, as I said, was a big mispricing of how the market perceived the Fed and how the market perceived the RBI. I think this time also the mispricing could be huge. That said, I think another thing that basically central banks are all trying to manage here is, how inflation is going to be the next leg of policy movement. Clearly, there's no doubt in the fact that you're going to be seeing disinflation in the world. There's going to be disinflation in India as well. And historically, what we've seen is that the recession is actually a very strong disinflationary agent. Historically, every recession has actually followed suit with a very sharp deceleration in the core inflation in the US, barring the 2020 crisis, which had led to a very different policy behavior, and which is why we are here, in terms of our imbalances on the global economy. But that said, historically, if you see recession are a very, very reliable disinflationary agent, there's no two-way that we will see a inflation coming off around the world, which will be led by recession. In our base case scenario, it will be a moderate recession in the US and not a mild one or a very strong one. Which also implies that you could be seeing a scenario wherein even as we are moving toward a recessionary state in the US, which is, as I said, likely to be a moderate one in our base case scenario, inflation could still remain sticky. So if you see these charts historically, even during recessions time, we have seen actually inflation still increasing and only coming off towards the fag end of a recession. So there's going to be a good chance that you would still see inflation probably remaining sticky in here and then falling very sharply as we hit recession. Because if you see these charts, this is where the period of recession that sort of plays out, and how after that there's a big fall that you see in inflation, except for this period, which is essentially the COVID period. But as I said, I think the next leg of discussion is going to be how fast and how soon disinflation takes place in the world, which implies that the central banks could have a very different take on, their own policy stance. We are seeing inflationary and disinflationary agent. It was a supply side issue, which had moved to a demand side. Now, both of them are looking at a disinflation across, if I look at some lead indicators in the West. But as I said, it's going to be a very painful path as you go into, this year or next year. Sticky inflation, which again is removing food, energy, and even shelter, which is something that people are talking a lot about in the West, and that is also playing a part somewhat in Indian economics as well. What you're seeing is that it's still pretty much sticky. Two supply side indicators, which are essentially labor as well as shelter, housing rather. Both of them have been, a pain point for the global markets in general, especially developed markets. In the US, what you saw was a participation rate, which had actually started falling very sharply post GFC, had never actually seen itself recover to a pre-GFC period, and COVID only worsened it. So that essentially implied that with the kind of demand upsurge that you've seen, and in fact, the kind of earnings numbers that you're seeing, especially for services sector in the US, there is a sense that there is a decent demand which is still playing out in there, and there's a decent demand for labor, which is also implying that despite the fact that you are seeing job losses now happening in the West, the unemployment rate is abysmally low. But I think the bigger fear for me is going to be that, as I said, this year we are going to be seeing disinflation pay out. Probably we will see, global inflation somewhere settling, or the DM inflation settling close to around 3% by end of the year. But are we looking at a regime which will see, global inflation or the DM inflation going back to 2%? difficult to assume, because, if you see the last 2 decades or so, there's been a lot of global forces which had led to the world being in a very non-inflationary zone to a large extent, where growth was also cyclical, but inflation was never a problem except for in certain emerging economies. But what you're seeing now at this point in time is that the world is moving to a situation where the government debts across the world are, very high, because of the fiscal, spending that they have done, especially post-COVID. And the sort of boundary that you're, seeing between the monetary policy and the fiscal policy is now becoming increasingly blurred in the more medium term, where you also see in India as well, how the policymakers play a part to some extent in managing the Reserve Bank's reaction function as well. And to the extent that somewhere the policymakers in the central banking side, probably have the mandate to manage cost of government borrowing, there's a good chance that, you tend to see a fiscal dominance play out in the more medium term in the US, in the world in general, which also will mean that, India, though anyway, has been seeing that kind of fiscal dominance, but it's something that even the West would probably be bearing it in the next decade or so. Also, I think, as I said, last a decade or 2 decades or so, the implication of globalization, demographies, and essentially have implied that, you generally are seeing a much lower cost of capital in general, a lower cost of inflation in general, because, there was a much better, supply chains in general, and in terms of, competitive advantages being, extracted in a much better fashion. Demography, of course, aging population, going ahead in the West will be a problem, because that will imply that the public finances are going to be more strained. So I think these two problems will probably, globalization and demographic being a problem in the West, will be factors which could keep inflation a tad more sticky as you go ahead. And the so-called 2% target that the West has been being very tricky on probably will need a relook, which also will mean that if at all the goalpost tends to move from a 2 to a 3%, maybe in a decade or so, emerging economies, which are also sort of, sticking to their so-called 4% target, especially for the Reserve Bank, may also have some kind of leeway with regard to their, repricing of, where they see their own comfort inflation rate at. So I think I'll just skip to this bit. Basically, this essentially talks about the fact that, RBI, which although did not accept the fact that they were essentially following the Fed to a large extent since April of last year, which is when they had done a big pivot last time. And this time again, the anniversary of that again saw the same kind of pivot in the RBI's behavior. And nowhere had they really mentioned that it was largely because of the fact that they were strong armed by the US policy making. And that time also we had argued that RBI probably, has gone way ahead of themselves in terms of how they are taming inflation. So basically, in a economic parlance, there are 2 or 3 ways in which you tame inflation using monetary policy. One is expectation taming, which is what Michael Patra loves talking about. In exchange rate targeting again, through which basically, you try to reduce the interest rate differential between the carry countries and the base economy, which leads to a higher foreign flows, leads to FX appreciation, and leads to an imported inflation coming off, and also the cost of capital going down in general. And third, and the most credible way of targeting monetary policy is the credit transmission, which is what generally we see most central banks talk about in general. I think in India, except for this particular transmission channel, which is extremely strong statistically also when we see, the rest two channels are actually not they have very feeble correlation with the actual inflation movement. And historically, we have not really seen much statistical proof with regard to how these channels of inflation management can actually be, very effective. So that essentially implies that RBI, which was sort of talking about taming inflation expectations, in terms of keeping the interest rate high, doesn't really work in practice. And so is the exchange rate regime, because to a large extent, if you go back and see, most of the policies have INR not moving one bit, even in a surprise scenario. So I don't think that, INR is very sensitive to interest rate differential, as most people tend to believe. On the other hand, when the RBI actually started targeting interest rates in early of April of 2023, 2022, sorry. That time the credit offtake had just started to turn positive. And if, in fact, the real credit offtake was still negative to a large extent until September of last year. Of course, it went up dramatically up in terms of, across the board in terms of, the participants in the credit market. But again, we are seeing that coming off to a large extent. So I don't think there was an overheating in the in domestic economy, which essentially would have required RBI to, go ahead with this kind of hike that they have essentially delivered. And more importantly, I think they did get swayed by, the EM reaction function in terms of comparing our cycle with the West, because, US saw a very dramatic increase in its labor market improvement. So if you see historically, all the past recession cycle in the US have actually seen payroll employment gain actually falling dramatically after the cycle, recession takes place or cycle peaks take place. This is the only cycle, which is a post-COVID cycle, which has seen a dramatic V-shaped recovery in labor market post the recession. So that's again sort of stands out, and it's still continuing to a large extent. As I said, payroll employment have slowed, but there's no job losses, across sectors as yet. On the other hand, when RBI actually started increasing rates, we were much below our pre-COVID level on employment, and only as early as the recent number is when we are seeing the employment levels actually reaching the pre-COVID level. So on a growth basis, we have practically probably 2 or 3% growth in labor market employment. So I don't think the backdrop of our economic recovery is similar to that of what you've seen in the West, and that's why it's not very fair to really get swayed by what they had done. Now, coming to the inflation aspect of our economy, again, we believe that we are largely going to be seeing a relatively benign inflation as we go ahead. We probably will be seeing a sub 4 prints as well into the year, but on an average, you will be seeing inflation somewhere close to a 5.2%, which is pretty much in line with the Reserve Bank of India. But there could be also risk which could sort of spoil the party for us. At this point, we're expecting the food inflation to trend lower on an average. But of course, there's a risk with regard to, how factors like milk inflation, which is, becoming a structural problem since post-COVID, probably could continue for another year or so until, of course, we improve the productivity of the dairy industry altogether. Or of course, how the El Nino plays out. Historically, we have seen that even in the year of El Nino's, food inflation on average have been manageable. As we stand today, the water table is quite comfortable. The reservoir levels are quite okay as well. And we still have a mixed assessment of, how the El Nino could play out by June or July. So at this point, we're not putting too much of a impetus on the fact that we could play an El Nino impact on drought, which could have an impact on food inflation. But of course, milk inflation for the year, we are taking a relatively higher print than last year. But food inflation on an average, we are looking at it to be trending down versus last year. Of course, the base effect also helps us. But I think, as I said, this time around, what we're probably going to be seeing is that the core inflation will be a tad lower than the headline inflation in certain scenarios, but mostly they're going to be hugging each other, which is what we historically see. Whenever there's a lead lag between the two, they tend to sort of merge in a matter of a year or two. It's generally the core inflation which tends to lead the headline and not the other way around. So the whole idea of generalized inflation that Patra talks about is also statistically not very strongly proven. I think near term, of course, as we all know, there's stickiness in core inflation, which has always remained. Interestingly, if you go back and see the way core inflation works, it finds a new level and then it stays there for a long time, and then it finds a new step down or a step up and stays there for a decent period. I think we're getting into a situation where CPI core will be somewhere sticky around 4.8 to 5.2% in the next 2 or 3 years regime, which I think is a comfortable number to track and not necessarily a very worrisome number, because I think that the 4% target is anyways a big stretch in an economy which is still growing and probably is going to be seeing a slower growth as we go ahead. You can stop me if you have any questions, by the way. So coming into the growth aspect for Indian economy, while there's a general perception that India would be a growth outlier this year in the world, which is looking to be slowing dramatically. There's been enough headlines which talked about the fact that how India and China would be the next saviors in Asia. And there could be a decoupling. Technically speaking, we will not see a decoupled story as such. We will still be slowing with the world this time around. And even historically, whenever you've seen that, India has sort of, seen, has decoupled from the West, it doesn't really sustain for a very, long period. We tend to catch up with the rest of the world in a matter of a 1 or 2 year period. So in the past also, when we saw, especially 2008-9 cycle, where, India had grown at around 8.5%. This was a period when there was a big fiscal stimulus that happened in the Indian economy, especially led by pay commissions. The world had grown at 1% and we had grown at 8.5%. That obviously, led to a very different picture the following year, wherein the world actually grew, but we slowed from our previous trend. So basically, it basically tends to catch up when it comes to recoupling with the world, even if it decouples in a year or two. We again have a very, very strong, this is an old chart. I think the new chart would see a big sharp downtick in the US investment. We have very high correlation with the US investment cycle and our own capex cycle. And as I understand, at this point in time, the non-financial capex is actually coming off dramatically in the US, and I have a feeling that we will sort of, catch up with them in terms of a slower capex growth next year as well. More importantly, I think exports, which was a big lever of growth in India, and especially in 2021 and 2022 mid and CY basis, essentially have enjoyed the fact that the global growth has been very rapid, and especially post-COVID, there was a big supply, disruption that happened in the world, especially in manufacturing and engineering goods, where India did reasonably well in, FY22 and part of FY23 as well. Essentially because whoever was able to produce and supply at that point in time gain, and India actually leveraged very well on that front in CY22 and CY21, which essentially implied that our we were getting export as a big lever of growth back home. But at the same time, if you look at the slower path of growth that we're looking at in the US, and which is with the lag in EU, almost 40% of our exports are actually inclined towards these two economies, and especially the services export, which are also pretty much vulnerable to North America and Europe. And they again were a big lever of our balance of payment management in FY23, and thus we're expecting IT services exports to slow from a 20% YOY basis in FY23 to as low as 6%, which is an ASCOM own forecast. Assuming that we see a recession coming in the US by end of the year and not earlier than that. If that happens, then probably the IT exports would see a much sharper correction. Now, coming to the growth agents, right? So basically the three agents that, could run the Indian economy to a next level. One is exports. Though medium term, we do believe that, policy implications of the PLIs and on manufacturing sector, and plus the fact that services are now looking to new leg of, discovery of, Indian talent in terms of going beyond software to non-software services, is going to lead to in India, being the services export agent again. And, medium term, of course, we'll see the spillover of FDIs that have happened in the last 5 years in terms of new R&D facilities back home, and eventually the impact of PLI, which are going to expire in the next 2 years or so, having its impact on the real sector eventually. And, exports could be next lever in the next 5 years or so, but at least in the next immediate year, I don't think we will see exports as the big support for Indian growth story. At the same time, consumption still seems to be very shaky. You still have an urban-rural divide, which is very visible. Rural real wages have remained largely negative. They started improving in mid of CY22, but have still remained negative, partly because of the fact that the rural inflation is actually higher than the urban inflation. And the terms of trade thus are still not very favorable for the rural economy. And which is also visible in the fact that, if you look at the, 3-year volume CAGR of, these two-wheelers versus personal vehicles, there's a big divergence between the two. PVs are generally seen as a proxy of rural demand, while two-wheelers are seen as proxies of rural demand, while PVs are generally seen as a more urban-centric growth indicator. So there's a big divergence between the two as well. If you look at the average real growth in the corporate wages or the wage cost of the listed companies, there's been a consistent increase in services, which is led by IT and financial services in the last 1 year or so. While of course, as I said that the real wages in the rural sector hasn't been really very dramatic or positive. But at the same time, we are seeing some early signs of rural employment improving. Last 1 year has been relatively tricky for them until I think fag end of the year, we were still seeing a mild improvement in the rural employment. But last, I think 3 to 4 months has seen a dramatic improvement in rural employment as well, which has gone beyond agriculture to across sectors. I think when we did this chart a while ago, there was a very interesting insight that we could get was that of the 7 million plus jobs that we saw in the rural economy having lost post-COVID, the gain that happened 2 years from then essentially was only inclined towards agriculture, while services actually saw a big fall in employment. And thus that sort of explained to a large extent why the wages in the rural economy was much lower, because agriculture is a disguised employment sector in general, which means that when you're moving from services, which is a high paying and high productive sector, to an agriculture sector, which is low paying and low productive, you are going to be seeing a much lower rural income in general, which explained why rural economy was not growing. But I think the near term indicators that we are seeing are looking positive for the rural economy as well, where you're seeing that there's been a diversification away from agriculture back to services, which should ideally improve the rural income in general in the medium term. But again, there are going to be more challenges, because if at all, the services sector doesn't really continue to remain solid, we will see the rural wages again going through a difficult phase into next year. And of course, agriculture would be a big problem if at all there's a drought, which impacts the production of the food grains. At the same time, of course, the third economic agent that people tend to talk a lot about is investment, which has been a missing agent since 2011. And as I said, we are looking at the US, capex story not really coming off in a very strong fashion. And historically, also we see that they have very high correlation in Indian GFCF cycle, or the fixed capital formation cycle. And at the same time, if you see historically, what happens is that the consumption and investment tend to generally go hand in hand to a large extent, because I think they're quite endogenous in terms of how they play, or how they sort of grow in a more medium-term fashion. So if you're not looking at consumption being a very solid indicator of next leg of recovery, there's a very low chance that especially in an uncertain environment, that investment would take a front foot and say that I'm going to be the next leg of growth. I don't think that is going to be happening. This time it will be a lagging indicator of consumption, because especially in a world which is looking at an impending recession, I don't think anybody would be wanting to put their investments up front, and rather not wait for the interest rate to correct and then probably enter into the long-term greenfield investments. So I think for the year, we are looking at the gross value added growth of around 5.4% as against 6.6%, which means the real GDP should come down to a 5.7% from 7% this year, which is, I think, much lower than the RBI's own estimate. And I think there's still a downside risk to this, because we do not still know how the global recession actually pans out. As I said, we are basing our growth story on assumption that you will see a moderate recession in the US, which will probably start by end of the year, early next year. But in case our assessment goes wrong, and actually the speed impact of the US transmission to the extent that you see a major damage in the world economy, I think it's very hard to assume that India would sort of be growing at above 6% when the world is correcting to a sub 3% kind of levels. Now coming to the Indian currency market, I think that's something that most people are focusing a lot on, especially given the fact that there's a perception that probably we are going to be seeing a sub 80 level on India's currency. I just want to make one point in this front. Like if you see the last correction in the dollar, which started, I think, from October of 2022. We've seen dollar, I think, losing around 13% of its value, where it saw the peak of 114. You've not seen the emerging market, FX playing the same kind of return behavior. There's been a lot of divergence in emerging markets. In fact, emerging Asians have been this time around much lower in terms of their gains. Most of them, CY, in this year have actually given negative returns, barring just INR. But most of the positive territory spot returns that you're seeing in this year essentially is coming from Eastern European countries, or to some extent Latin countries, which actually are giving a much higher carry versus Asian economies. India also, I think, even though it's giving a much better carry than some of its Asian peers, barring Indonesia, hasn't really performed that well. It's just barely at a positive of 1%, as against 15% loss in dollar index that you've seen since October of last year. So I don't think that it's very easy to assume that just because the dollar probably is going to be seeing a further downtick in months to come, you would see like-to-like comparison in emerging market currencies. Of course, India has certain positive, positive points in terms of how our currency could play out, but I don't think that we're looking at a scenario where you would be seeing a sub 79 on INR, which could sustain. For the year, actually, we are looking at the third and fourth quarter to be averaging close to 80, which also means that you would see a sub 79 this year. But just to make a very interesting point, historically, pre-election year generally tends to see INR depreciate. So I think if you go back and see last year election, which happened in 2019, on the day of election versus a year prior, you would see almost 15-20% correction in INR. And historically, last 5 election cycles, if you see, rupee tends to depreciate a year before election, to the extent of 15-20%. So that's very interesting stats. It may or may not happen because, again, there's a huge dispersion in the thing, but on an average, you see INR depreciate. Directionally, there's been never a case in the last 5 cycles that rupee has appreciated a year before the election. So that's a little difficult for us to assume that you will see a sub 79, which will sustain, unless, of course, you expect the dollar to really crash to a sub 90 level. So I think dollar will also see a resistance around, it's currently at 101. I think DXY would somewhere see some moderate correction to the extent of, maybe a 97, 98, but I think it'll have a resistance around those level because, as the world is still expecting USD to probably weaken because the Fed is relatively on a more pause mode versus its other DM peers. Market is still expecting that there is going to be some accident which could probably play out by the end of the year. There's a good chance that dollar becomes a safe haven back again, and probably tends to remain sticky at, or probably strengthen from there, that level. And then, as the economic recovery again takes place, or the policymakers start cutting massively across the world in a synchronized way, dollar tends to weaken. But there's a good chance that dollar becomes corrects from here on and gets a little sticky, strengthens, and again weakens in probably fag end of the year. So I'm not very sure whether the EM would be fully party to it, especially in recession period or post-recession, when you see dollar weakening, unless, of course, there's a big money inflow that actually starts flowing out of DMs to the EMs. I doubt that you would be seeing DM, EM following each other in terms of playing against the dollar. For India, of course, as I said, there's a mixed to healthy backdrop for INR. There's been a better import cover, partly because imports have actually fallen because of the weaker growth recovery in the last 6 months or so. But RBI has been able to recoup some of its reserves as well. But at the same time, the reserve adequacy actually has been falling in the last 1 year or so. And next year will be improving to some extent, but it's still below the long-term average of 3.5%, 3.5 months or so. At the same time, the net, your international liabilities to the world have actually improved in the last 2 or 3 years, and I think it's set to improve further as you go ahead. The only glitch was that your investment income, which is basically the cost of capital that you pay on an annual basis to the world, had gone up dramatically, partly because of the higher interest rate, which will now starting to look relatively easy, which means that the total net international liabilities to the world, which is a very strong indicator to understand how much you owe to the world and how much it could have an implication to the currency when a global crash happens, seems to be in a better position than what it was in any of the past cycles. Next year, what we're seeing is that I think we have the fourth quarter CAD numbers still due, which will probably see CAD to near neutral level. But in next year, we're expecting current account deficit to come down dramatically to a 50 billion kind of a number, which will essentially imply that it will be probably 1.3 to 1.4% of GDP as against 2.1% this year, of which the trade deficit obviously playing a very important part. But another lever which has to be, which has been actually been covered by most of the media guys now is, how non-software is now becoming a new lever of support for invisible segment. So software, of course, has been growing very well from 110 billion, which it delivered in FY22. There was a big increase, of 20% plus in software IT, which is actually driven more by the mid cap and the unlisted firms than actually the large ones. And we expect that to increase at a moderate pace of around 5-6% next year. But I think the non-software segment, which still is a bit of a black box, because to a large extent it is coming from business consulting or the GCCs of the world, the global competitive centers that most of these non-financial companies are actually opening in India, especially post the Ukraine war, has seen a dramatic increase. And I think if there's been a new setup which has been moved from one part of the world to a new world, I think it generally is a more sticky variable and could actually remain. We've still taken a very modest increase next year. I think this could see an upside in terms of what it could generate. But again, overall, it is still a function of how much global growth is happening in the end, because exports, be it services or be it non-services, are in the end a function of how the global growth is evolving. So if at all that variable remains tricky, I think you could see a risk there. But clearly, this is one agent which has seen an improvement to an extent, that is unfathomable and difficult to sort of focus unless we understand how these business models are actually evolving. But at the same time, there are some slower growth agents also, FDI, which has seen a dramatic increase in the last 3 years, and this is net FDI, not gross. Gross has been very solid to around 80 billion plus. Net FDI on an average last 3-4 years has been somewhere close to 40 plus. This time around, we've seen almost a 10 billion or 11 billion loss versus the last 3 years average. And that large part of the loss actually has come into services again, because most of the FDI inflows that we saw in the last 3 years in India were essentially all the PE money which went into these unicorns of the world, which of course didn't seem to be lucrative proposition, and most of the PEs tend to exit their investment within a matter of 3 or 4 years. So that seems to be fading. I think manufacturing has to be a big leg of FDI for us to see that so-called big bump up in the exports in the manufacturing sector, which is what the government of India has been targeting, to see an FDI inflow which will be more sustainable as we go ahead. But that said, I think on a broad basis, you are seeing the balance of payment becoming almost near positive scenario, which tends to augur well for the rupee. But again, it's not a very dramatic increase. In the past also, we have seen the BOP being, extremely positive, but that did not imply that the rupee had a dramatic, turn in terms of its fortune. But historically, they tend to go very well hand in hand. My sense is that you should be, as I said, probably be seeing a sub 80 or 79 kind of a number. But for it to sustain is something which is difficult to assume unless you expect that dollar will have a secular fall as you go ahead into the next year. I think we already talked about this particular segment of CAD, basically the new agents of CAD, which is non-software services, which are again led by professional and management consultancy. There's been a big increase in that category in terms of the new investments of most MNCs. I think one segment which probably did not get much attention from the current account point of view is the net NRE deposit accretion. So what essentially happens in the transfers, most of us understand the transfers as unilateral cash transfers that happen from the Middle East or from the US. But actually one segment of the transfers is your redemption of NRE deposits. So what essentially was happening the last 1 year is that most of the NRE, NRO deposits which are rupee based NRI deposits, when they get redeemed back home in the domestic economy, they're taken as a entry in the transfers and not a part of your NRI deposit in the capital account. That has seen a big fall. This is a deposit accretion which has seen a big fall, essentially implying that there's been a big increase in the redemption of NRI deposits, which is reflected in this particular category, which is shown that your NRI deposit, your transfers have increased from an 80 billion average. I mean, historically 78 to 80 billion is what you see historically, the number being. This time around, there's been an almost 20 billion increase. Of that 20 billion, there's been I think around 10 billion increase of this delta is coming only because of the fact that there's been a huge redemption of NRI deposits, partly on account of people getting better returns back home, so they would prefer their parents or elderlies to actually invest back home in the FDs rather than them doing the NRI deposits. And two, I think a lot of these banks, which are leaders, pioneers in NRI deposits, had actually persuaded a lot of NRIs to reinvest this money in real estate refinancing, which was a big money churner last year. But that obviously helped your current account, which is not something most people are actually talking about in terms of why you saw a new delta coming in on the current account basis. Another factor, I think we had covered it very extensively in one of our reports as well, is how electronics exports is coming out to be a big lever of next leg of manufacturing in India. I think it was until 2 years ago, it was not even top 10 exports of the Indian economy. And sitting today, they are actually comprising almost 4 to 5% of our total exports. And I think the top 5 in terms of the growth that they have delivered versus most other peers. And we had done some analysis in terms of how smartphones specifically could become a big lever of electronics export, which could increase their share from hardly a 4% currently to as high as 15% in a best case scenario, assuming that Apple is able to deliver onto its own ambition of increasing India's share to 25% of the total production that they do in the world. If you want, a copy of that is also available with you all. I think these guys will be sharing it with you. Now the last segment, and then we can open to Q&A, is where are we seeing the GSET market actually correct? So if we look at the US economy, we have seen from the peak of 4.2% that we saw in the US 10-year, we are sitting with a 3.3%. There's been a massive, almost 170 to 90 bips rally that you saw in a matter of, just around 6 months or so in the US. Back home, there's been obviously a spillover, the same that has happened. But I think to a large extent, India's rally has clearly taken place in the last, last month or so, while in the US, the fall has been happening over the last 6 months, especially post, of course, RBI policy was a big lever. I think before that, we were looking at the curve being relatively much more steeper. We're looking at a much flatter yield curve in general. And, as most people are expecting the RBI to remain on pause as we go ahead, we are expecting them to change their course only by early next year, which is in line with the Fed in terms of further cut, in terms of rate cut. So that, I think, on an incremental basis may not be a big policy lever for the sovereign yield curve to actually come off. But the next leg of correction will essentially come from 2 factors. One, that the global rate trajectory is going to be tricky as you go ahead. US has already seen almost 100 bips of rates rally in the last 6 months or so. And there's a good chance that it'll probably continue because, they are pricing in a very, very high rate cut. If that doesn't get delivered, then also I think there's a decent steam which is to be left in the US economy. But in case if there's a big slowdown that actually plays out in the West, you will see the sovereign yield curve across the world seeing another level of correction. I think the big wedge between the US yield and Indian yield again implies that there will be either a catch up from this side or that side. My sense is that the US will further fall and Indian yields probably will catch up on the same lines. Again, on the demand supply mismatch, which is basically the fact that, as we keep talking about the fact that India has a very high supply overhang this year around as well, because we'll be seeing centers borrowing close to 15.5 trillion as against 14.3 trillion last year. And even state gross borrowing also remaining close as high as 8.5 trillion. There's a big supply, which is impending close to around 23 trillion, 24 trillion for this year, as well as 22 trillion last year. We were able to sort of sail through last year. We still had a excess supply of GSEC, but as we stand today, the yields are actually still lower than what they were beginning of the year. Next year, I think, we should be able to sail through with regard to demand supply, demand again coming from banks and PD, insurance, provident funds, NPAs, NPS, as well as, some FPIs of the world. I think the big lever which is coming out to be, big support for the government securities demand is the others category, which was actually used to probably give you around 1.5 trillion plus kind of a number. I think that the NPS is becoming a big lever of incremental GSEC demand, because the AUMs of that segment is still growing. And of course, there's been certain black boxes which we are unable to explain in terms of how they've led to a very high increase in so-called others categories in the GSEC demand. But nonetheless, I think if this category continues to remain solid, I think we should be able to sail through, assuming that the RBI would be able to support the liquidities in the economy by infusing close to 1.5 trillion worth of OMOs. That's our base case, where we're expecting the SLR demand to remain healthy from the bank side, because we expect the credit offtake to slow down, to a sub 10.5%, and deposit growth to actually outdo the credit growth, as well as RBS, pitching in by, doing open market operations to the extent of 1.5 trillion. With that, I think somewhere you will be able to match the demand supply mismatch, and which also will mean that the GSEC, which tends to move more by the local factor than by the global factors, should see local factors also being supportive in general. And I have a sense that you should be able to see a sub 6.75 in a very 6 month period itself. So I think that's it from our end. We open to questions if any, and we'll share the feedback and the key takeaways from the presentation from our end. But any questions, we're happy to take.
Ma'am, how do you look at the role of RBI in fighting inflation and the global turmoil that India is going through?
So, see, inflation, of course, monetary policy obviously plays its part, as I said, through the credit transmission channel, largely in India. It doesn't have a very strong statistical proof on, managing inflation expectation, because I think they are more backward in India. Household don't really play out their expectations, assuming ki RBI ye kara ya wo kara. They don't understand that much of it. So largely it comes by the credit offtake route. I think the transmission generally is a 6 to 9 month lag on an average. We already have seen a decently high rate hike or a decently strong, real rate at this point in time, which is, I think, hovering close to 1.5%, which is 50 bips higher than RBI's own neutral rate. So I think as you go ahead, there's a natural tendency that you will see demand slowing. And with a slower demand, it's but obvious that your, demand-led inflation will come off. So that's also one of the reasons why we're expecting inflation to anyway come off in general. And there's a lead lag between the policy and its transmission. But sitting today, I think we still have a decent demand impulse, but it's very mixed across segments. And you should see a secular demand slowdown as you go ahead into the next year. So which again will be led by policy to some extent.
Ma'am, on the opportunity front, how do you look at India in this period of global turmoil, where Russia is busy with war and US is fighting this bank chaos, inflation, and other issues over there?
We also have our own issues. No, so I think, in terms of so you're talking more on the geopolitical point of view, right? So no, we have, I think, diplomatically, we have sort of gained in the last 1.5 years post-COVID and post when, friendshoring is a new, the new term in the game, where India is sort of being able to sort of lever itself well with its partners. Plus, at the same time, I think strategically also we are well placed geographically to be able to, gain in certain segments, like in services. Again, I said, we were able to, there's a decent, I mean, we don't have a proof for that, but anecdotally speaking, there's been a big substitution that will happen from, say, Eastern Europe to countries like India, post the Ukraine war, where the certain services, non-software services, actually have been moved to Indian markets, and that is what the GCC offshoring has reflected to some extent. So I think you are able to tap the diplomatic ties much better strategically. Again, you are placing your geopolitical bets well. So we'll see how it plays out, because the global global geopolitical tension is going to only increase as you go ahead. US China tensions are something which will probably be staying for the next decade or so. China plus one strategy again is something that most Asians are keeping an eye on. We are also competing with the world, with the likes of Vietnam of the world, which actually have seen electronics goods have gone much higher in their value chain than what we have at this point in time. So I think we are catching up on that front, and policy actions have been aligned to the fact that they are not only strategically placing on the geopolitical front, but also doing their ground homework well. So we'll see how it pans out. But I think immediately we're just trying to make the best of our political relationship with both the economies.
Adding to what you mentioned about China plus one strategy, and apart from that, the Taiwan issue, which is prevailing right now. So how you look at India, first, how you look at India as far as China plus one strategy is concerned? And apart from that, when you look at Taiwan, do you think like India is a rising hope in the chip shortage, the chip market?
Chip market is a very different. So they were, I think chip market is, you want to answer that?
So,
on the
from a China plus one point of view, of course, there is some movement of supply chains away from China that's happening. India is benefiting from that. One of the biggest examples, again, which has been covered quite extensively, is Apple, right? Moving production to India on its own, estimating that up to a quarter of its production could move to India in the next 3 years or so. That's one example. And of course, then that helps because if you have big brands like Apple setting up production facilities in the country, that gives other companies confidence, and there is a network effect that can be formed. So in that respect, of course, China plus one as a strategy, given India's, the dynamics of the Indian economy with the population sort of advantage that we have in terms of the young population, education, and of course the growth potential that the country has, there is a massive opportunity which countries, manufacturers from all over the world are beginning to account for. With regard to chip production, I think that's a much more difficult thing for India to sort of get a share, even a toehold in, I would say, because of two reasons. One, of course, the production of chips is not something that can be easily sort of picked up and moved across borders or across countries. Taiwan has an ecosystem that's been built up over years. China has an ecosystem that's been built up over years. So again, if I come back to smartphones, I think about 70 to 80% of the world's smartphones are manufactured in China. So that's because there's an entire ecosystem that's built there. And with chips, the TSMC, which is one of obviously the biggest manufacturers of chips in the world, is of course based in Taiwan. It is setting up factories elsewhere, but it's as diversification again because of the threat that China poses to Taiwan, say in the next 10 years or so. But that is not happening in India. It's setting up factories in the US and I think in Europe, if I'm not mistaken. So India, because of just the specialized nature of chip production, I think is a long way away from being any sort of player in that respect. But from a broad China plus one strategy, of course, we are benefiting already. And depending on what other sort of incentives the government can provide, what other sectors we see, say, PLI in, and the overall sort of dynamic of how the manufacturing sector gets support, there will, of course, be benefits that we'll see.
And besides, we need that kind of skilled talent to be able to manage those, chip manufacturing plants. I don't think that's ready at this point in time. That's probably a more 5-year down the line story. But again, it's always starts from some place or the other. So now you are seeing India being a big emerging hub in terms of smartphones. Obviously, there will be further, investment being done on that front, at least to be able to, create a competitive labor to be able to manage those chip manufacturing plants specifically.
I have two questions. The first on the commodity side, I want to know that how you think the prices of crude, which are so volatile right now, and they are, in the last 3 days, they lost some 10% or so. So, in the call with John, I remember he said that the inflation is going to stay high because of high commodity price, high food
Correct.
prices, basically.
Correct.
So how do you see that play out, given that food prices are so volatile?
So I'm not a commodity expert, firstly. I think so, most of the time we tend to see it in line with the financial markets because that's what we understand, right? So generally crude is seen as inverse related to say DXY. Generally, when dollar weakens, when dollar strengthens, it tends to sort of hit the crude in a different way. So basically, at this point in time, my sense is that it's largely driven by what you're seeing in the demand side of the global world, where people are expecting a big slower demand in general in the global economy, which is weighing on the crude prices. But at the same time, the way the geopolitics really tend to play out, and especially in the food market, which was supposed to be in sunset period, is now again back into being a period where you would probably see the food market being an important player in the transition from a conventional to non-conventional energy. My sense is that even if you see a huge correction in Brent, which will probably be sub 70, you will see a supply response from OPEC in terms of production cut, because they clearly are understanding the fact that this is the last leg of or last hurrah for them to be able to make most of the situation at this point in time, and I don't think they would let go of it very easily. So my sense is that even with with the kind of correction that you're seeing in Brent, there's a very low probability that you will see a further correction from here on. I think it would remain somewhere sticky. It'll be a very wide range, to be very honest, which is what we are seeing. It could range from as low as 65 probably for a very short period to as high as 90, but I don't think that it would sustain in either of the ranges. And my sense is that somewhere you will be averaging close to 885. That is what we have also taken in a forecast. So we may go wrong on that. If that really happens, should be a again something which is a tailwind for us in general. But it's a very difficult call to take, very honestly. Commodity prices are not just a function of financial market, but also a function of the actual demand supply of these goods.
Also on the currency side, do you see other developed currencies like euro again, considering that inflation is where it is in the euro, and the ECB is expected to hike rates further in the Fed right now? So do you see the euro again gaining on the dollar, and hence do you see consolidating somewhere even below 97, 98?
So that's where I'm seeing it somewhere sticking around. DXY already, I think yesterday also it fell around 1.5%. There was a broad-based fall in dollar yesterday after the Fed policy. And the divergence between within the DM is still playing out, right? I think ECB is also lined up today, and market is split between 25 and 50 bips on ECB. Either ways, they are not letting. In fact, they're actually seeing inflation pressures being more sticky than in the US at this point in time. It's beyond shelter for them. Their economic recovery also has been relatively decent. Of course, recent data has across the world sort of surprised on the downside, but ECB has traditionally been a much hawkish central banks than this Fed in terms of the so-called 2% target, and they are close to around, I think, 5.2, 5.3 on the core inflation. That is what they target. So there's a long way for them to go. I think the divergence would continue for some time. And I think Europe is relatively looking to be a better placed to be in the growth front as well versus the US. And same is the case with the BOJ as well, which is at this point in time, still looking to be following the Kuroda's path. But I think there could be a tightening, which is, or the abandonment of YCC, which is impending in the next 6 months or so. So I think near term, you could see dollar further weaken and versus DM currencies. I'm not sure whether it will be across emerging market that you will see the benefit, because not all the EMs are giving a very strong carry. So what I had shown in one chart as well is that within emerging market in the last 6 months or so, what you saw is that while dollar had fallen, from the highs of 114 to 101 or 100, emerging market across has not seen the kind of gains that dollar has lost. And there's been a very wide divergence within emerging markets where, the Eastern European and Latin currencies, which were actually front leading the Fed also in rate hikes, have actually gained now. And they're still hiking rates. Yesterday, I think, Czech Republic also raised rate, and within Asia also there's a very high divergence. I think except for Indonesia, I think no other currency has gained more than 2%, 3%. That's the only outlier country, and India has gained plus around 1% or so. So I think that divergence could continue within the emerging markets in the next 6 months or so as well. So even with the dollar, say, finding a new level 98, I don't think that we are looking at INR, going below 78, 79 and sustaining there. So that could be a tricky part, and we'll see how things pan out. But I think at this point, dollar could actually come back, to 100 plus level even after touching a 98 is what I'm assuming.
RBI is not worried about the interest rate differential at the top, because it's narrowing.
No, it has already narrowed, so it's much lower than what you've seen historically. The gap between the chart which was showing that the US yield had also fallen much faster than ours. But see, as long as the flows are not getting impacted in negative fashion, they are pretty okay with it, because in the end, INR is not very sensitive to interest rate differentials. It probably plays out in a more longer period, but not in the immediate run, unless of course it's going through a very dramatic pain. That is when you take an interest rate defense. Otherwise, it's not a very effective tool in a normal parlance of monetary policy.
Question regarding economic operation. Do you see, are they going ahead with them in the first half of this financial year?
No, I think it'll be more towards second half, because the liquidity will tighten much more there, is what we are assuming.
Possibility of CRR cuts in this financial year, because we have been from what we have heard from the market does not expect as of now a CRR cut, at least in this financial year. So do you think they will go ahead only with the VRR to inject liquidity?
No, yeah, they won't. I don't think they'll be touching the CRR this year, unless of course, they are out of tools. They won't do that.
There's a question from one of the online participants, Mr. Deepak Mandal. He's asked, what is the current contribution of manufacturing in our GDP, and how much do you think measures like PLI would help increase the contribution of manufacturing in our GDP?
So manufacturing close to 23-24%. And so I don't know how successful the PLI scheme would be, because that is a more medium-term story. But the aim is to make manufacturing the lead, from a 24% to probably increase it to another 35-40%, which also imply that there will be substitution either from services or from agriculture. So at this point in time, agriculture is around 15 to 18%. So I'm hoping that the delta which comes from manufacturing should eventually imply that agriculture will probably play a much lesser role, which I don't think will be the next 2 or 3 year story, probably more a decadal story. I think manufacturing, India's manufacturing is still not even 2 or 3% of the global value chain. I think we have a long way to go on that front. My sense is that for it to increase from a 25 to 35, 40% is at least a decadal story. These shares don't change, every 2 or 3 years.
My question was the global decision fund. So you have mentioned in your presentation that India is not insulated from the global inflation. So can we see an adverse impact on the Indian economy if the global decision turns out?
No, yes. So I mean, roughly, if I look back and see the correlation, roughly a 1% fall in global GDP leads to around 0.3, 0.13% fall in India GDP, assuming everything else goes okay in India. So, and if you're looking at a big correction in global growth, I don't know how deep the recession. I don't think anybody is actually able to take a bet on the fact that there will be a hard landing or a soft landing in the world. Whichever way you see the world correcting, I think there will be it's a no-brainer that India will be impacted. You are in a globalized world. The intensity of it will depend on how bad the global correction is. So as of now, I think India is looking to correct roughly from 7 to 6% if I take an average. So I think a 1 percentage point correction versus the world correcting by 3.5 percentage point. So basically, we've only been able to percolate down only 1/3 of the pain.
And also the GSEC front, we have seen in the last 1 month GSEC yields have fallen, especially the 10-year bonds, more than 25 basis points. So at what levels can we expect that it will sustain?
At this point, very difficult to say again. I think we are keeping a bet that, we will be seeing a sub 675, because I'm expecting one, the global yields to continue to fall. Two, the demand supply dynamics being relatively better compared to FY23, which will be held by RBI almost in second half of the year. So I think you could even see a 650 depending on how, if I'm looking at a US 10-year yield to say come off to a sub 2%, what stops me to believe that RBI could also, the 10-year could also see a, sub 6 also, for all you know. But generally, your global dynamics again sort of get spilled over in domestic markets to the extent of hardly 30-40% of what is happening in the world. Domestic fixed income market is very, very domestically driven than owing to global factors.
Follow up. So, you mentioned that within global growth is obviously going to have an impact. You also said that, because of monetary policy from those factors, we will see slower demand going ahead. So, is that what is expected to pull down GDP? Slower demand. Basically, we're expecting lower consumption.
Correct.
In GDP for the fiscal year, while government investment like capex and
So total investment, what matters? No, government investment is a substitute of it, right? Overall GFCF will be driven by private sector because government is only say 32% of the total investment. That is what you see as a percent of GDP in India, of which 6.5-7% is total of government and public sector. So they are a very marginal player in the whole picture. In the end, it is the MSME and the large sector corporates which tend to drive the capex story in India overall, which again is linked to what's happening in the interest rate scenario in the economy, the demand expectations, your inflation expectations, and political stability. I think pre-election, why would anybody want to start a new plan to something when they know there could be economic uncertainty which could be lying next year, or a global recession which is lying. I'm not looking at a consumption story which is very robust, because until a quarter ago, one was still not sure how much of it is actually the post-COVID impact, which is fully playing out, or there's genuine increase in demand. So I think there's a lot of noise with regard to these things. My sense is that you will see, both urban and rural income sort of actually, easing in the next 1 year or so, which will have impact on consumption, and which again will have an endogenous impact on, investment also as you get into the new year. And exports again will be a function of global demand, which will be correcting, even though you expect them to do better than say the rest of the world because of services being a lever. But I think on a broad basis, exports would not be a next leg of growth, at least in the immediate run. Maybe it's decadal story, yes, but not the immediate run. And government of India, again, how much can they spend? Because they're anyway correcting their fiscal, right? So the fiscal impulse is still negative. So from a 6.4, if you're targeting a 5.9% fiscal deficit, you may be doing spending here and there, but on broad basis, you are still reducing your spending to some extent. So as a economic agent, you are not contributing to growth of the economy.
And what is the outlook short term for the 10-year GSEC?
What is the short term for you? Tell me tomorrow. Are you trading in the GSEC market? And I'll tell you accordingly. Around 3 months, I think we are already at 7 today, 7:01.
697.
It's yes, we've reached 697 today. I don't know. Yeah, I think the near-term outlook looks to be obviously on the downside, but I'm not sure whether we can break a 675 immediately. But I'm looking that to happen in the next 6 months or so easily.
You did touch 97 and then run back above 7.
Yeah. So see, again, it's basically depicting what is happening in the world and what is happening in the commodities market, because crude is also corrected to a large extent. But again, it's not an apple to apple comparison, firstly, because the world there is very different from what we are seeing back home. We are still boasting about the PMIs, which are looking at a 57, 58 versus US export, which is now, comfortably a sub 50 level. So I think it's a little tricky a situation back home as well, because there's a very mixed growth picture that you are seeing at this point in time. But I think that the correction that you saw in the US yields yesterday night has not reflected exactly the same way back home. But at least on a directional point of view, it's very clear that you're going to be seeing correction in the yields going ahead, because everything is supporting the bond market in general, right? If there's a slower growth in the West, that should support the global yields, which will again have a spillover impact back home, which obviously will imply that RBI, if at all there's a big damage in the world, RBI will have to act much faster. My base case is that they're acting only next year now. In terms of a rate cut or whatever pivot that they take into consideration. Nothing is happening during this year, because my base case of Fed is also early part of next year. So I think immediately the only lever that could play out for us is that there's a big correction in the US yield. So 675 itself is a very big barrier for me to assume, because there has to still be a spread between a GSEC and a 10-year, right? Sorry, a repo and 10-year, right? We are looking at a GSEC market, which is at least giving a spread of 50 bips against the repo rate, right? So if you have a repo rate with 650, you can't assume the 10-year to actually go below that, no? Then your curve itself will be inverted then. So if you see statistically speaking, on a more medium term, it's the REER that impacts the exports and not the nominal exchange rate. That is more meant for your pricings of invoices mostly. And it's never immediate reaction, immediate impact of, say, a currency movement into the real sector. As I said, real sector will also be impacted by the inflation back home, because the overall cost of the good matters when it comes to supplying your goods to the world. But even with a strong currency or a weak currency that plays out, there's always a lag of 3 to 6 months in general for the markets, global markets, to take cognizance of the fact that this currency is cheaper. The total cost of production of the goods in this particular country is cheaper, because that obviously has a productivity dynamics also in play. So I'm assuming a strong, a weaker currency is also held by much better production cost in India, which makes the final good much cheaper. And if that happens on a consistent basis, then there's a global shift in demand that comes to India with a lag. It doesn't happen immediately. It's a good, assuming that your currency remains weak and your production cost remains efficient over a long period. That is when you see the global market participants actually moving their base from an X country to a Y country or an economy. So there's a big lag of 6 to 9 months that with that happen. That's a global phenomenon. But nominal currency movement is not the only lever which leads to an export growth. Otherwise, with that logic, Germany would have never been an export, engine of growth, because they clearly have a very strong currency, right?
I have a couple of questions. One is on the rural economy. You pointed out a few reasons on why the rural economy is
Correct.
not growing. Could you please repeat that?
So I think the bigger problem for the rural economy was, I'll take the post-COVID period. There were 2 or 3 things. One is that the real terms of trade, which basically how much they're getting versus how much they're actually spending to sustain, was largely negative as per our calculations. And also the rural wages, real wages, which is which includes both agriculture and service sector in the rural markets, adjusted for inflation, have been largely negative. They have started going up in a positive territory, but they were not really able to get into a situation where they could sustain in a and that was happening, I think, pre-COVID as well. It was not just the COVID period. Before COVID also, rural was a struggling segment, right? So that sort of got accentuated. And I think until very recently, we were not seeing a very sharp increase in rural employment. So whatever loss of employment that happened post-COVID, it got recouped in a matter of 1 year plus in rural. But until very recently, what we were seeing is that the switch or the quality of employment gain that happened post-COVID was largely in favor of agriculture. Of course, Narega was always a support, but beyond that, when we were looking at the permanent, employment, it was largely getting reflected more in agriculture versus other segments of the economy, which is basically construction or services, which are largely informal services in the rural sector. And agriculture as a segment itself is a low paying and low productive sector. So the overall income growth in the rural sector apparently had become much, much lower than what it was pre-COVID, which I think is now improving at the margin, is what we are made to understand. But again, we'll have to see how much it sustains, because the data is quite patchy and we use the CMI database for assessing how the employment is behaving.
Okay. Another question is about the services exports. You said it's going to dwindle coming down. I'm just trying to understand what exactly led to the growth of services right now in this particular area, because we can see a pickup in the last few years, but what really fueled the growth in this particular plan?
So services basically this time around has been held by both software and non-software services. That's one big thing, one takeaway. Software across the world has done well. There's been a big IT boom that, you could see the IT companies' results also have been quite solid. Most of the IT companies, especially the, mid-sized one, actually showed robust results, which also was somewhere reflective of the kind of the revenue gains reflected in the services exports. I think the world has seen a services gain in the IT segment across. Non-services again is something that is basically being driven by the business and professional management consultancy is what the RBI breakup shows, which I think is most of this should be understood as the global comparative centers that most of these non-financial companies are opening up. Like, I was talking to someone, the pharma sector, so they've opened up an R&D segment, which is Global Comparative Center, which is they've opened in Bangalore. And same is the case with a lot of these financial companies also having KPOs or their increase in those facilities, especially again focused more in the southern part of the country. Then even legal services for that matter have seen some movement. Some ad hoc projects also have gotten increased in terms of the quantum. So those are again the annual thing that I'm talking about. The data in pure sense shows that there's been a big increase in the business consulting regime, which is non-software led. So if there's a shift in the in the way that they're operating, from say X part of the world to a new destination that they found in India, to a large extent, whenever the new facility that opens up, it stays for a long period. They would do their investments and they would have at least a 3 to 4 years horizon. It's not like a financial investment which sort of goes away the next year. So there could be a permanent impact of that which could stay for these services. But again, they are very sensitive to the global growth story. Because if there's I think across the world, you are seeing the tech correction happening. So there've been a lot of tech layoffs also, which are now playing out. So the sense is that if I go by the NASSCOM's recent commentary, they are looking at a much slower exports growth in the IT sector also this year, which is again largely led by the fact that you will see a recession in the West. The timing of which is obviously uncertain, but we are still looking at a positive story, positive growth in exports, a much slower one in this segment, but at least still positive.
Services and electronics are two levers of growth. Is there another sector that you're looking at in the coming few years, which is going to drive exports?
I think exports to a large extent, textiles is something which we had missed the bus. India was a leader in textiles a decade ago, which has been taken over by the Bangladeshis and Vietnam of the world. I think we are doing a lot of, investments or PLIs in textile sector, which is now technical textile that they're focusing on and not the conventional or traditional textiles that, we had a advantage in a decade ago. So I think that could be the next leg, because we had lost the race in that. And now we are focusing on our competitive advantage in the sector, which is largely technical textiles and not conventional textiles.
One more question is on, I wanted to understand what can the government do on increasing capex, because we are seeing very less credit deployment as far as capex is concerned. As far as credit for private sector is concerned, we're seeing a lot of demand for personal loans and everything.
Correct.
So what do you think the government can do?
But they've done it enough in terms of already, trying to instill some kind of positive confidence in the economy in general, especially by, in fact, when they had started off this PPP program, which is basically public-private partnership program. They actually, I remember some 5-6 years ago when they initiated this program, they actually took over the large part of, setting up the plant and then giving it away, to the private sector to run. That also did not really take off very well. Then they had come out with the national, NIF fund, which also did not really see the light of the day in terms of increasing capex. Then they had tried the DFI model, which also did not work. So I think it's more a problem of instilling confidence in terms of increasing consumption demand, increasing or sort of improving the domestic dynamics in terms of the cost of overall production, overall investment in the economy. And my sense is, as I said, that unless, of course, so, what happened post 2010-11 was that there was a big slump in investment, but consumption was sort of sailing through till 2015-16. And then we kept hoping that, investment will catch up, because they tend to be very endogenous in nature. If you have a sense that there's a big demand bump up which will come in the economy, you will obviously do investment. If you talk to most of these guys who plan to do greenfield investment, wouldn't necessarily have a sense of, next 5 years in terms of how the consumption would really play out. So I think in the near term, till the time we don't see a consumption uptick happen in a sustained way, which has been missing since, as I said, 16, 17, we had demon. Post that, we've only seen consumption plummeting. It's not been the growth lever for India. It comes cyclically, but it doesn't, it's not like by the end of the year, I would say consumption was a story for India. It wasn't. So till the time that happens, I think investment would sort of be more shy and, mostly brownfield. So we are seeing the capex of the personal GDP has been stagnant at around 30 to 32% or so if I remove the COVID period. But it's not been able to increase itself to a large extent. Even with a better savings dynamics back home, ideally it should have led to a higher investment because the cost of capital came off post-COVID, but that did not really happen. My sense is that it's going to be a story of consumption which will lead investment.
One last question is, there's significant talk around de-dollarization and it's coming with a new currency. So what's your outlook for dollar?
That's a decadal story. Again, it's not happening today or tomorrow. We'll see. I mean, there have been blocks which have been formed. Again, there's been, friendly discussion between certain countries as to how they could substitute the dollar and could do their trades. We also have seen internationalization of Chinese yuan. We also have talked about digital currencies being the next vogue. We'll see when it happens. Till the time we don't find a substitute which is as good as dollar, it's still something which is in the, just in the talks. Anything else?
Any online questions?
We had one view.
Okay, so we all have lunch on this side. So I think that we step out straight down towards the left. And if anybody wants to go to the.
Hello, everyone. Thank you for joining in here. Thank you for joining the media roundtable today. Hopefully, the discussion today was helpful to your understanding of the Indian economy and the global economy. And we look forward to meeting you again. Thank you again. You may sign off.